Would you agree that adjusting the SLR would free up capital for banks to invest more in treasury markets and other low-risk assets that would be beneficial to families and businesses across the country?
I would agree, yes.
Certainly, during the COVID crisis, it was temporarily taken off, and it had a big effect.
Well, have you heard the news yet about the ESLR, the Federal Reserve unveiling their plan to reduce capital rules imposed that were after the great financial crisis? Well, in today's Stock Market Brief Show, we're going to dive into that. We're going to dive into expected moves, what's going on in the markets. And yeah, we're going to start off here with what is the ESLR. Now, first and foremost, I'm no expert in this, and I don't pretend to be, but a little bit of research goes a long way. What is important to know is how did the markets respond to the last time that a rule like this was initiated. And that's what we're going to show with you. So quick background of what is the ESLR or the SLR. It's the Enhanced Supplementary Leverage Ratio. This was introduced as a part of a broader post-2008 crisis reform, the Basel III rules. Okay, so it's a leverage ratio. It forces banks to keep a minimum level of capital relative to their total assets. Now, simply put, right? It makes banks safer by ensuring they have enough money capital to handle unexpected losses. Now, the timeline for when it was officially adopted was 2014, right? But it wasn't enacted until 2018. Now, in 2020, this is when they actually utilized temporarily, they excluded treasuries and reserve balances from the SLR calculation, easing constraints on the bank. It was more of an emergency measure. In 2021, related temporary exclusion expired. Banks once again included treasuries and reserves in the SLR calculation. And now in 2025, it's being reintroduced here, with the Fed proposing revising the ESLR rules to reduce the required ratio from down 5.6 to roughly 3.5 to 4.25. This is just some quick research there. And there's currently a 60-day public comment period before the final approval and implementation. Now, what happened during that time? Well, we went through the pandemic and they did what's called the emergency measures there, right? They took emergency measures and, well, the markets absolutely just ripped up, right? The gray shaded box is the time that it was in effect. And you can just see here a monster rip up, and then it continued even more to the upside before going into the 2022 bear market. Now, from what I found, the difference between what took place in 2020 to here, I think is somewhat important. The purpose of 2020 was emergency liquidity, right? It was an emergency measure. 2025, from what I'm understanding, is there's a longer term regulatory reform. So the duration of 2020 was temporary, as we highlighted. It was about a year. And the 2025 proposal, the duration is to be permanent. Now, the implementation, it excluded treasuries and reserves. The 2025 proposal, it's lowering the overall ratio. So the impact was immediate and short term, and this is more ongoing and structural. And as from what I heard here from Scott Bessent, they say that it did, they referenced 2020 and how it brought rates down and so forth. And there's a lot of people saying that this is some sort of form of secret QE. So I think it's important to kind of just be aware and see how the markets react and respond to this. I will say in the last couple of days, bank stocks have been catching fire. You can see JPM has been just on this monster rip up breaking out, and that's not the only one. You can look at Goldman Sachs. There's other banks out there too, and various other names that we've been seeing monster moves. Now, I don't know if this is more the end of month, end of quarter window dressing. We're going to find out more, obviously, coming into the next quarter as we're going to get new earnings season kicking off, and financials are the first ones to report. We also have news that Trump could be replacing the Fed chair, and I think that this is somewhat important to kind of monitor and watch because the tone of all the Fed members now are kind of saying, I think that we're leaning against a cut in July. And it's like, okay, are they just doing the song and dance, so maybe they're picked to be Fed chair type of thing? So it's a very interesting situation because if you look at the Fed watch tool, they're pricing in, I thought it was 2 rate cuts, but I checked again here at the end of business, they're pricing in 3 rate cuts now to the end of the year. And I find that to be a little interesting because there are various commodities and assets that are signaling we might actually see inflation uptick here in the back half of the year, which could take those rates off the table. Like, for example, copper futures has been a big move that would contribute to inflation. Other big contributor to inflation would be oil, and oil has come off quite a bit, but we did shoot up significantly off the geopolitical risks. And we'll see if is oil going to come back up and start moving higher. That could put pressure back onto the inflation numbers. And if we take a look here, what has been going on in recent correlations, this up here is the dollar, right? This here is the 10-year yield, and they've both been kind of going down. And what has that been doing? That's been helping the S&P 500 perpetuate to the upside. So it's going to be very critical to watch these correlations. Correlations, they come and they go, but they typically change and alter during specific economic environments and times. So for example, this time right here, what was taking place? Well, we had all the trade war problems, and I mean, kind of still doing those issues going on, and everything kind of correlated. We went down. But you can see over here, there's a long period of time where the dollar was drawing out to the downside, 10-year yield was drawing out to the downside, and the S&P 500 kind of just kept on cranking up higher. So right now, there's somewhat of a negative correlation, which means that you should be keeping a very close eye on this dollar. Now, the dollar overall is bearish, right? We talked about a potential bounce up over here. It bounced up and since then has been faded, but we do still have that positive divergence forming in the RSI. And when things get oversold, they're due for a potential bounce. So just be aware that if the dollar were to come in and all of a sudden bounce up for whatever reason, that could very well have an impact on things that are negatively correlated to it. You can see right now we're just trading a series of lower highs at the moment. So if you are, bearish the dollar, I mean, I wouldn't like to be beared up down here. I'd be looking more, right, if we were to get a bounce and then we're to see some follow through more to the downside, would be a little bit better of an execution. But if you're thinking this in terms of a short seller, right, and you're trying to initiate and you're bearish the dollar, I mean, how good would this entry be right here? Well, maybe in hindsight it'd be really good, but typically after already some strong selling, it's more of an area to cover and look for a bounce and then try to reestablish those shorts. So I think that's going to be important to watch there, and obviously rates as well. Now, this is the S&P 500. I want to talk about kind of what it is that I've been doing. First and foremost, in a positive gamma environment, which I'll show you if we're in that or if we're not. In a positive gamma environment, when we're above the flip line in the S&P 500, I look to find stocks that are contracting, going sideways, setting up, and looking to break out. And, on the last video that I posted, not the last video, the one prior to that, the stock market brief, we went over like 6 different names, and they all, from what I understand, they're doing pretty good, and they're breaking out of those type bases. So that's what I'm continuing to do as long as we're in positive gamma. I'm more of a position trader, swing trader, and when things start to get frothy and extended, which they have been, I start to reduce exposure, but I still end up putting exposure into various names. So in this context here, looking at the S&P 500, it's basically at all-time highs right now. I wouldn't be surprised if we don't. I'd be surprised if we don't get to all-time highs there. That'd be pretty impressive. We kind of broke out of this little consolidation, head higher, and we're outside of the quarterly expected move, which I'll show you, and the week-to-date, a weekly expected move here too as well. So the market's kind of squeezing through these levels as it stands, coming into end of month, end of quarter. And this is typically where I'm just going to let off the gas. And if there is a good setup, which I posted some in trade ideas today, I'll rattle off some of the names, but I don't have the charts in front of me. I looked at TXG, I looked at PZZA, I looked at Amazon, I looked at Starbucks, I looked at GM, I've looked at Trade Desk, Bros. So some of those names, if you pull those charts up, you'll see what I'm talking about. But when it comes to the S&P 500, just understand that if it were to slow down, consolidate, pull back in, and so forth, it could affect and pause various stocks that are obviously correlated to that as well. So as the S&P 500 is moving up, as the dollar is going down significantly, I wouldn't be shocked here in the very near future to see some sideways price actions, consolidation, and then we got to see what earnings brings, obviously. Now, I find this to be rather fascinating because during all this volatility down here, I would say go back and watch some of those videos. For example, like this video over here, I always like to prepare people ahead of the potential move, right? It doesn't really make sense to say, go long here and that's like, and then it goes down over here or whatever. But I like to give people more of a heads up, 7 days, somewhere around there, to be prepared for the potential of consolidations, pullbacks, and or moves to the upside. So for example, if you were to go back to these videos on this down move and maybe go back to this day over here or this day, this right here was a very specific day. We call these follow-through days. It's where the market goes up more than 1.25% and you have more volume than the prior trading session. And we say this is where you want to start adding exposure into the market because no bear market, no correction is ever went into a new phase without seeing one of these follow-through days. And the reason why I'm bringing this up is because there's always people in these levels that don't want to believe that the market can go higher. Actually, in fact, I was probably one of the standout voices saying this is where you want to start adding exposure. And the amount of trolls that showed up, or the amount of people say the lows aren't in, or the low isn't in, the lows are going to go lower. It's like, okay, maybe, but if the market starts to prove itself, you want to start to see and start to get ahead of that, because who knows what can happen. And in this case, it was a very smart move to start getting exposure, looking for stocks and so forth. Now, the reason why I'm saying that is because where we are now, I'm saying the same thing, right? The market's kind of been, we talked about the shakeout period. I think right over here, the market went down, kind of shook around, it went up, it came back down over here, and now we're getting a few days of a squeeze to the upside. So I would not be surprised to see it move up and potentially come back in and doodle around more, given the context of a lot of the signal charts that we've been seeing. In fact, most of this move has been driven by tech. You can see here, institutional clients net buying of tech this last week was first in the history. This was dating back to 2008. But it's no surprise that when tech is on board and you're seeing these monstrous moves, that the S&P 500 is going to push forward. But the problem here is when you start to see more breadth divergences, which I'm starting to see more build up, more breadth divergences, some internal weakening and things like that, the market doesn't hold up for very long, right? It can go and go, but if nothing ends up cooperating with it, you go through a period of consolidation, pullback, rotations, and so forth before the next leg higher. Okay, so that's kind of the thought there on the S&P 500. When we zoom into the 2-hour time frame, this has been an area since probably around 6,000 we've been talking about, the upper quarterly expected move, and then we now have this upper monthly implied move for June. So June is well within the month, but we are outside of the weekly, and we're currently outside of the quarter. This quarter expected move was given to us at the start of this quarter. Now, at the end of this month, the quarter's over, and this was a crazy quarter, right? At the beginning of the quarter, we were at the very bottom of the quarterly expected move, and we came all the way back and we're trading outside the upper end of it. So if you remember, when we were actually outside, pretend this is the quarterly move, when we were outside of it, the world was ending, and we were saying what? We're saying this is actually typically the time where if you're a longer term investor and you see these type of kind of blowout type moves, it's fine to actually add in if you're holding for the longer time. And now we're outside of the upper weekly implied move, and I'd be saying the same thing. I'd be like, it's probably not the best time to be going long after a strong move like this. But if you start to see consolidations and you start to see things catch up like averages and so forth, and we're still holding that gamma flip line, which is just at about 6,000, yeah, this is the environment where dealers look to buy the dip, sell the rip, and volatility typically comes in. Okay, as far as the direction of the 5-day moving average across all these assets, SPY, Q, IWM, semiconductors, biotech, and DIA, they're all above. Biotech is much more of a lagger here, but hey, if the market wants to keep going, this could be one to potentially watch here. It is coiling up. It's holding above it too, which is nice. So perhaps this, might start moving here in the near future. Biotech's been a monster laggard, but everything else is above rising 5-day moving averages as it stands in this current moment. If we look at back month, first front month volatility, it's not extended by any means. The last time we got up to this 20% reading up here, the market did start to consolidate and pull back, and we're reaching back up into these levels. So if the market wants to squirt a little higher, pay attention to this, because when we get to these levels, that's typically where the market starts to consolidate and pull back. I also watch the expected moves. Expected moves are important to watch, right? If you go to my Twitter account and you look at the expected move that I posted from in the morning, we tagged it to a T, the AsherBot expected move, the IVOL range, the blue level, and it came in. And tomorrow we are looking at roughly at about 615 to 616.50. This zone up in here for the spine. This is the 15-minute time frame. And then beneath us, we got 608 to about 607. If we were to come down here, that's pretty much in line with kind of back where the weekly expected move is. The higher probability is to come back to the weekly implied move, but when you actually start to break from these levels, this is actually very normal behavior to see happen. When you start expanding through this and you start seeing volume uptick, what happens is dynamic hedging kicks in, and when the whole market gets an entire weekly expected move incorrectly, they need to adjust, and you can get these pretty vicious type of gamma squeezes out from those levels. So tomorrow's daily implied move is there, as I stated. The upper monthly is right there as we're coming into the final trading days of the month. And then down here, we have the quarterly expected move, weekly expected move. As it stands, I'm just paying very close attention to what market net flow looks like and how I'm trading. If you want to go and watch how I trade from an intraday perspective, I shared it on this video. The first time I posted this video, it got taken down, so I reposted it and now it's staying. But I took from a prop firm, I took $2,500 and I turned it into currently $45,000. But if I actually get my next payout, which could potentially be in the next 5 to 7 trading days, they'd be moving me to live, so I'd get a larger payout, and it actually moved that $2,500 investment to roughly around $80,000 in payouts. The month of June right now has been just an absolute heater, and I share my setup. I share everything on that video. And one thing to remember is the day trading that I talk about in here works better when you're underneath this gamma flip line. But sometimes throughout the day, you might get some news headline hit, which opens up the door for the volatility to play in. Now, if you want to look at some of the daily expected moves, I share them all here on my Discord, but I'm going to share them with you today. So tomorrow's expected move for the SPX and so forth down the list, I've started to include gold expected move, gold futures expected move, crude oil's expected move. I got Ready and Q. I got the upper level, lower level, and I have the 2 standard deviation levels too, if you'd like to take a look at them. Hope today's video gave you a little bit of insight on this secret QE that the Fed really kind of just introduced here, that we were all hearing about just a day ago. And some thoughts on the S&P 500, the correlations with the dollar, and what I've been doing personally from a swing trading perspective. And if you watch this video, what I've been doing from a day trading perspective. Hope today's video helps out. I'll see you on the next.